본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다. 안녕하세요. 2022년 설 특집 월가 트레이더 버니와 함께하는 진짜 미국 주식 시간으로 찾아뵙습니다. 저는 진행을 맡은 이수연입니다. 코로나19로 시작된 다양한 경제 변화 속에서도 계속해서 갈 종목은 가고 또 가지 않는 종목은 가지 않는 그런 차별화 장세가 연출되고 있습니다. 특히나 작년부터는 미국 주식에 대한 관심이 상당히 인기를 끌었는데요. 오늘은 지난해 소개해드렸던 이 버니의 미국 주식 시간에 살펴본 종목들 다시 한번 체크해보는 시간을 가져보도록 하겠습니다. 어떤 종목이 한 해 동안 영향력이 굉장히 컸고 또 어떤 종목들이 올해 더 성장 동력을 가지고 커나갈 수 있을지 집중 체크해보는 시간이고요. 오늘 1시간 동안 저희와 끝까지 함께하면서 미국 주식에 대한 꿀팁들 챙겨가시기 바라겠습니다. 자, 그럼 2022 설 특집 월가 트레이더 버니와 함께하는 진짜 미국 주식 지금 시작합니다.
Graphic processing units in the business, and it has great software attached to those. The two best uses of graphic processing units are both showing explosive growth for NVIDIA: gaming and the use of artificial intelligence. Both uses really take advantage of the parallel processing capabilities of these graphical processing units, or GPUs. Everyone knows gaming, and the newest GPUs are going to expand their position in the gaming industry. NVIDIA gives gamers access to high-end gaming performance through annual memberships where they can get this experience of these powerful GPUs without actually owning one. And this opens up the market to more and more units. This opens up the markets to more and more users. These users have paid $100 per year, and now with the upgrades will have the chance to get much more capability for $200 a year. With 12 million members, that extra $100 generates an additional $1.2 billion in revenue annually. It's all on the margin. All of this indicates that NVIDIA is doubling down on the cloud gaming market. Its strategy of making high-end gaming accessible to gamers without the hardware to play resource-heavy games locally through the cloud can create a substantial recurring revenue stream. And it can help NVIDIA remain a top growth stock for a long time to come. Now, when you've got the NVIDIA gaming, you can also, typically you watch it on your computer, but now you can stream this thing through what they call their media streaming device, Shield TV. You can stream these games in 4K HD on your TV, which they couldn't do earlier. And this Shield TV allows the users to stream video content direct to their television through apps and not just using their computer. So I think this opens up so much more use for the gamers. They have been a leader in gaming ever since Microsoft picked NVIDIA for their use in the Xbox. But now we're seeing these deep learning and artificial intelligence being able to take on more and more complex tasks. And basically, deep learning and AI allow the computers to write their own software. NVIDIA's GPUs enable this more than anybody else's, and this has tremendous impact on developing self-driving cars, say for example, and intelligent machines. So on top of their gaming, they have all this artificial intelligence that they've been able to access, and both of those areas have awesome growth potential. Also, because of this parallel processing design, if your data is in the cloud, NVIDIA's GPU's deep learning is available to you on the services that you get when your stuff's in the cloud, either at Amazon, Microsoft, or Google, or IBM, or wherever the cloud storage is. And we all know the huge growth capacity in cloud growth. That's been pervasive in so many of the stocks that we've tried to highlight. NVIDIA is part of this growth, and it's a huge beneficiary, just like other companies we've been talking about. Whether it's been Snowflake, Arista, Microsoft, or others. Well, NVIDIA's earnings, like we talked about, are driven by the twin growth streams of gaming and data center revenue. Gaming revenue was up about 40% in the most recent quarter to over $2 billion. Data center revenue, which is all that cloud revenue generated, is up 162% to $2 billion. So now they're about equal in terms of revenues. Gross margin was 62% in the third quarter, much higher than you might think for a hardware company. But that's because NVIDIA also has this great software that comes in with these graphical processing units. Over the last decade, NVIDIA has been working on a new generation of a graphics card. This company is now in the second generation of that device, and I expect it to encourage 200 million of its gamers to upgrade. The GPUs typically cost between $500 and $1,500. 200 million gaming users is a lot of users, and I expect that number to continue to grow. In a word, the stock performance has been great. It's been consistent. It's been even better since the April low in COVID. And we can see that on the chart right here. There hasn't been really, outside of that little COVID scare what we had in basically late February to early April. Other than that, the stock has not really had much of a setback. And that's because the growth in both divisions that they have for their GPUs is outperforming expectations. When we look at that same period of time, we can see that the stock price on the chart on the top part compared to the ratio of NVIDIA to the Nasdaq Index on the bottom part, we can see how much of a time over the last 5 years the stock has outperformed the Nasdaq Index. And we can see that when the stock underperformed the Nasdaq Index, it didn't really go down because basically the market was probably trying to go work its way higher during that period of time. This chart, basically, I would say this chart is 80–85% of the time it's outperformed the index in the last 5 years. When we think about that, and then we go back and we think about Google, and Google's only outperformed the index probably about 30–35% of the time. Well, that's why this stock has really outperformed Google to such an extent, or other like-minded companies in terms of relative performance to the Nasdaq Index. Like I always say, we always want to have a portfolio of stocks, say 15 to 25, that we're going to hold for 3 to 5 years. And 3 to 5 years gives them long chances to outperform the Nasdaq Index. And we need to find stocks that are in disruptive technologies, disruptive industries that are going to outperform expectations. NVIDIA is definitely one of those stocks. Jensen Huang, who still runs the company as its president and CEO, he owns almost 4% of NVIDIA's stock. That stake is worth about $11 billion. I have talked about how valuable it is to find CEOs that own and are committed to a significant stake in their own company. I think this is so important. He is vested in the continued performance, and he's only 57 years old. He can still run this company for a long time. He started this company in 1993 and brought it public in 1999 at a market cap of $200 million. Today, it sits at a market cap of over $300 billion. Last year, NVIDIA announced its planned acquisition of ARM Holdings from SoftBank for $40 billion. This deal is going to expand NVIDIA's addressable market, seeing as ARM's chip design is in 90% of all smartphones. In a future-focused strategy, this is where NVIDIA is going to go. NVIDIA's chips are going to be used in Verizon's data processing center for the rollout of its 5G, which presents a massive market opportunity for the next 5 years. We're always trying to think of how the company is going to get to this next 5 years worth of great growth. And I think this is a great opportunity for NVIDIA. Apple's great trait has been its strong consumer appeal. The brand is a promise that you make to your customers that you need to fulfill every day. It's a really hard thing to do, especially at scale. When you think about a company like Apple and you think about how that brand has been created over the course of decades. Apple has done it though. Today, Apple is the #1 brand in the world by most surveys. And they have delivered for nearly 20 years since their start with the iPod. For years though, people have said that Apple needs to deliver another life-changing product. Okay, that's really hard to do. But even in this course of that, in the last, say, a year and a half, Apple stock has still gone great. Okay, Apple's just made things better, much, much better. Sony had a Walkman before Apple did the iPod for music listening. Motorola had the flip phone before Apple made the iPhone. AirPods have been a great invention, but we had earphones before that. The Mac computers, they didn't lead to great returns as other products. They were expensive. They didn't have the memory capacity that they really advertised. But when we just think about Apple, there are other things that a really strong brand can deliver. And Apple has made its money by locking in so many ancillary revenue streams through these great products. The iTunes Music Store, the App Development Store, and finally, a famous brand allows for pricing power. And Apple's products and services are expensive, no doubt about it. And they continue to charge high prices for their products and all the supplemental products associated with the main product lines, which leads to added revenues for Apple. We talk about the services side of the business and how that's the direction in which they're trying to steer the company. They're not just a hardware company anymore. They're doing an excellent job with that. But what it really all does at the end of the day comes back to that installed base of iPhones. Well, as I just mentioned, Apple's doubled since the start of the COVID issue last April. It's tripled since early 2019. It's now a $2 trillion market cap company. Can it continue to deliver outsized returns and outperform the stock market? I don't know. Only time's going to tell. But it's now so big that we've got to take that into consideration. Is it reasonable to continue to expect fantastic returns from Apple in the next 5 years? Well, probably not. Technically, you can hang on to these shares over the course of the next 5 to 10 years, and maybe those shares double, maybe they triple. And then technically, you've got a 200 or 300% return over that period of time. And let's not dismiss stock returns of 15% annualized over the course of 5 years. And that's basically a double in a 5-year window. But I would expect other stocks to outperform Apple. I fully expect them to continue to innovate, though, and be one of the companies leading the way in developing new markets, particularly as technology just continues to dictate everything that we do in the world. If they succeed to develop a new life-changing product like people are thinking about, it has the potential to really impact this business. I just think that over the next 5 years, we must be prepared to challenge ourselves in monitoring stock price performance of big, huge companies just like Apple, to ensure that it truly does continue to outperform the index, because that's what we're trying to do. We're trying to outperform the index. We want stocks that are in disruptive markets, disruptive industries, and we want to be able to get stocks get onto those stocks early on and to be able to outperform. Apple was clearly one of those in the previous life. Great stocks are disruptive in their industries. The challenge now is to whether Apple can still be disruptive. So if we look at this Apple chart right here, and this is a chart of the last 5 years, we can see that there's periods where this stock has really outperformed and done great. When I take a look at the stock and I compare it to how that stock has performed relative to the Nasdaq in the last 5 years, we can see that there's times when it's done really well, and then there are times when it's kind of chopped around a little bit, and there's some small times where it's underperformed the index. So the arrows that are pointing from the top chart to the bottom chart reflect the stock price performance on the top chart, and on the bottom chart, it reflects the stock of Apple divided by Nasdaq Index. So what we're really trying to say is as that ratio goes up, the stock is outperforming the index, and that's the time we want to be in that stock. We can see that in the period of 2018, end of 2017, beginning of 2018, that stock really waffled up and down relative to the index, and we really didn't go anywhere. But if we look at what happened in that stock, say, from the COVID time on, that stock has done great. And now we're trying to define where it's supposed to go now. So I don't know if the stock can outperform the index like it has, like it did between early 2020 and mid to early 2021. We're going to have to just wait and see. To be able to outperform a market, the stock has to grow at a faster level than the market, and we have to see that the stock continues to have an increasing acceleration of earnings. We just don't know yet. It's going to be really hard on a $2 trillion market cap stock. If you think about this, holding Apple probably is still a really good trade. Is it a great trade? I'm not sure. When we think of stocks that are in disruptive industries and disruptive markets, they tend to be smaller stocks, a little bit more, I don't want to say riskier, but a little bit more volatile in terms of the stock price performance. If I think about things, would I rather have $10,000 of Apple stock or $2,500 worth of the Trade Desk stock, $2,500 worth of Upstart, $2,500 worth of Bill.com, and $2,500 worth of Arista? When you look at each one of those stocks, they may be more volatile than the Apple as a whole, but if you buy smaller pieces of those stocks and you diversify that, those stocks are clearly outperforming, and that's what I'd rather be involved in, is disruptive stocks where they are where I expect their growth to be substantially better than the market and the industries that they're in. I don't know if that's going to be Apple. So if I want to compare it, I would rather be in those 4 stocks at $2,500 each than one time in Apple at $10,000. But I still think Apple is a great company, and it has excellent prospects going forward. When we talked about Microsoft last, we talked about Microsoft's Azure division as being the impetus for all this growth, because it's over the last 5-6 years that Microsoft stock prices increased so substantially. And I believe that growth is still going on. We've probably got another 5 or 6 years of that. In addition, about a month ago, Microsoft's board authorized a $60 billion extension to its share buyback program. and raised its quarterly dividend from 56 cents to 62 cents payable in December. That's a significant share buyback program. The most important takeaway that I think is that Microsoft is seeing an increase in the number of larger, long-term Azure contracts. This is important because it shows that Microsoft's strategy of having the widest, most comprehensive suite of software solutions is paying off in spades. A client may sign up for core Azure, that's that infrastructure as a service group. But then Microsoft can sell those clients an almost unlimited menu of additional software applications across the full software stack, be it cybersecurity or something else that goes on that they sell, whatever it is. The ability to sell additional products or services to an existing customer base is a form of pricing power. Microsoft, like many great companies, with strong investment potential, protects the intellectual property vigorously with patents. In 2016, Microsoft boasted as many as 59,000 US and international patents with 36,000 patent pending applications. In 2020, just a year and a half ago, Microsoft was the 8th biggest with 2,900 in force issued patents globally. Even more interesting, Microsoft ranks as number 5 for the most patent filings in artificial intelligence, which is where I think the focus really is in 2020. If we look at the last 2 years of Microsoft stock performance, and it mirrors the last 5 or 6 if we expanded that chart out, you can see in this chart that the stock basically is kind of gone straight up. It doesn't have much of a sell-off outside of the COVID experienced in March of 2020, and I think it's still going higher. It didn't really sell off, which is important when we think about it, in the sell-off that we've had in the markets over the last, say, 4 to 5 weeks. When I look at, just in the last couple of years, like the last 4 years, how Microsoft has outperformed the Nasdaq, you can see it right here. Microsoft is the black line, Nasdaq is the blue line. That outperformance has been significant, and it's persistent over time. Always when I look at a stock, I want to be in stocks that outperform the index as a whole, and I use the Nasdaq 100 as the index. So I take a weekly chart and I compare that weekly chart to a weekly chart of that stock divided by the Nasdaq. And the Nasdaq I'm using is the QQQs. So as long as that ratio is going higher, my stock is outperforming the Nasdaq. If that ratio goes lower, my stock's underperforming the Nasdaq. They can both go up, but the Nasdaq's doing better. I really want to focus on being in stocks that outperform the Nasdaq, because that's where the true gains in the stock market are. And we can see in this case, there's basically been about 3 turning points. You could see at the beginning of the chart where the stock price ratio relative to Nasdaq started to outperform. And then it set back a little bit, and in that case, the stock still did a little bit better. And then it flipped again, and now we are in that second large set of price increases when we compare that stock on the top to the ratio of the stock divided by the Nasdaq on the bottom clip. So all of the stock price performance we can see in general will be occurring when that ratio, that stock is outperforming, that ratio is going higher, that stock's outperforming relative to Nasdaq. We're in the very early years of a substantial global shift to electric vehicles. The European Union, for example, has introduced proposals that will effectively ban new fossil fuel vehicles sales after 2035. And we can safely expect other major areas of the world to propose similar measures soon. When most people think of an electric vehicle, what do they think of? They think of Tesla. This mind share among consumers is so valuable. Tesla has the potential to become for electric vehicles what Apple has become for consumer electronics, a trendy, premium brand. If Tesla can retain this brand value as other big car companies like General Motors, like Volkswagen, bring their own electric vehicles to market, this is going to result in better pricing power for Tesla and better profit margins for Tesla. I love the way Tesla has marketed itself. It's so different than others. You don't really go to find big dealerships in the United States where you go in, you drive, and you test the car. You basically buy a car online. And then what they've done is they've marketed what you're going to get so differently than other people. And what you get is service. You get better technology within your car because of the software technology that's built within the car. You're basically buying an experience. You're buying a futuristic thought process of being able to have a clean energy process. And you're doing it without all the infrastructure that dealerships around the country basically are forced to expend. You don't have that expense in Tesla. Well, Tesla's stock return right now, which is awesome, okay, so far is a vote of confidence on the impressive lead that Elon Musk and his team have created, not only in electric vehicles, but also in autonomous driving technology and data. Others, though, are doing the same thing. Volkswagen is going to strive towards all electric vehicles. Alphabet's Waymo, GM's Cruise, they're all starting to come online with autonomous driving. But Tesla has spent years innovating and building a leading brand position that will be tough to dislodge. Just like Netflix in streaming, or Amazon and online shopping, or Apple and smartphones. That's what Tesla is for electric vehicles. With an $800 billion market cap, and maybe even more right now as the stock has gone higher, Tesla won't triple anytime soon from here. But a double over 5 years is certainly within reach. What Netflix did to Blockbuster, what Amazon did to Barnes & Noble and other bookstores, what Apple did to BlackBerry and Motorola, Tesla is doing that to the big automakers. A purchase of Tesla stock today is a bet on the future. You shouldn't buy Tesla for what it is now. Let's be honest. The valuation probably doesn't support that. If you buy it, you buy it for what it is in the process of becoming, the dominant manufacturer of electric vehicles on the planet, an innovator in artificial intelligence and autonomous technology, and a global leader in clean energy production and storage. So if we look at Tesla, this is a chart of the last 5 years. And what's so impressive is that it looks like Tesla didn't do anything for the first 2 or 3 years. And then since the beginning of 2019 till now, it's gone basically in orbit. It's really done tremendous. Part of that reason is because consumers now know that when they buy a Tesla, they're buying a great car, they're buying a cost-effective car for them on a relatively speaking basis. And we're able to basically provide the technology to be able to analyze their cars from a maintenance standpoint. It has gone in the last month and a half, basically it has gone to a different level. And that's why my whole comment is, I don't know where this stock's going to go in the next 5 years. If we take a look at the stock and we break it down over the same period of time, I always try to think about stocks that outperform the market, and I try to define that outperformance in a very specific way. Because what we want to have is a portfolio of 15 to 25 stocks that we hold for 3 to 5 years that outperform the market. Tesla is clearly one of those stocks. The bottom clip of this chart, this two-pronged chart, is the relationship of Tesla stock to the Nasdaq Index. The top clip is the actual stock price itself. And we can see that when the ratio of Tesla to the Nasdaq Index is improving, and this is a weekly chart with a 20-week moving average. If it's above the 20-week moving average, that stock is outperforming. We can assume that stock is outperforming the Nasdaq Index. And that's where all the returns are. So we want to be able to be involved in stocks that outperform the Nasdaq Index. So if we are involved in this stock when it's above its moving average on that ratio basis, that stock performance for us is going to be tremendous. Google, or Alphabet, has been a great performer over time. Google's main businesses are still generating robust growth, and its stock still looks reasonably valued. The company faces a lot of regulatory headwinds, but it still should survive the coming storm. And by regulatory headwinds, I mean antitrust and monopoly lawsuits. Google stock has jumped about 60% so far in 2021. But if we look at the breakdown of who owns the stock, the institutional share of the ownership has weakened somewhat this year. This performance has been very different than the performance between early 2016 and the beginning of this year. Between early 2016 and through the end of 2020, Google really did not outperform the market. Everybody thinks about the FANG stocks and how valuable they all are, but Google didn't really outperform the market from 2016 through 2020. This year, it's outperformed the market. The two real questions are, why did the stock perform so well after COVID? And will this outperformance continue? Number one, it's a dominant force in online advertising. This is a Google world. Google includes the world's most popular online search engine. It has a mobile operating system, Android, which is a market leader. It has streaming video sites, YouTube it owns. It has a web browser that's the best in the business, Chrome. And it's got an email platform that so many people use, Gmail. Google will likely account for 29% of all digital ad spending worldwide this year. That is a tremendous number. Facebook is second at 25%, but everybody else in the world is in single digits. Lately, though, Amazon is starting to take market share from Google in this internet search-related advertising space. Number two, the growth of the Google Cloud revenues were $8 billion in 2019, $13 billion in 2020, and $9 billion in the first half of 2021. They're growing great. But it's not profitable yet, and it lags behind Amazon and Microsoft, both in terms of how much and in their growth share. So it's not gaining share compared to Amazon and Microsoft. Google's going to continue to invest in this space. This division has the best revenue growth, but is underperforming on income in this division. Unlike Amazon and Microsoft, Google lost $600 million in the third quarter in its cloud division. Now that's a lot less than it lost last year, but it's still a significant amount. Number three, Google's core businesses look strong, but there's a series of antitrust battles that could derail this growth potentially. The Justice Department filed an antitrust lawsuit against Google for its alleged monopolization of the online search and search-based advertising markets. And then B, it's also reportedly preparing to file a second antitrust lawsuit to address Google's dominance of certain advertising technologies. Also, the European Commission accused Google and fined Google of leveraging those platforms to drive its competitors out of their respective markets. Google also faces additional antitrust battles in Australia, India, and South Korea. Google's antitrust challenges cannot be ignored, I think. But I also think they're not going to cancel out its strengths. Yet Google will likely keep growing, even if it gets hit by fines and new restrictions along the way. Google is a FANG stock. Everybody thinks FANG stocks are great, okay? And if we take a look at some windows, we can find a window that we really like each one of those stocks in the FANG universe. But if we look at the last 5 years, only this year did Google outperform the Nasdaq Index. And we want stocks that outperform the Nasdaq Index. Between 2016 and the end of 2020, Google actually underperformed the Nasdaq Index. When we go back and look at Google stock over time, its great growth was when it was a smaller company between 2004 and 2008. It wasn't the big name, but that stock really appreciated between 2004 and 2008. Now, if we look at the stock chart right here that we have, you can see that this chart looks great. But the window that really looks good is 2021. The other times it still went up. It just went up less than the Nasdaq Index. And to show this on a basis where we can break it down, this is the chart on the top, the same chart that we just looked at, where it's the share price of Google over the last 5 years from, say, late 2016 through now. The bottom chart is a comparison of Google versus the Nasdaq Index, Google divided by the Nasdaq Index. And if Google was outperforming the Nasdaq Index, that ratio would be going higher. We can see that since the end of 2016, the beginning of 2017, all the way through the end of 2020, the stock either chopped around a little bit, that's where my oval circle is, where it kind of outperformed, then it kind of underperformed, then it kind of outperformed, then it kind of underperformed the market. But when we go back and take that period where it chopped around, and we go back and look at the stock price on top, we can still see the stock continue to grind higher. It just didn't grind materially higher. And then in 2020, the stock actually significantly underperformed the market, particularly after the COVID bottom in April of that year, 2020. But since 2021, the stock has gone great. And I think that stock has gone great on the heels of the continued investment in cloud technology. Even though Google's losing money, it's still investing quite a bit, and it's the number 3 cloud technology warehouse. So it's still a significant event. Okay, so we have to think about where that growth is going to go looking forward. Where is Google going to grow? Where are they going to outperform their industries? Where are they going to outperform expectations of growth? Are they going to grow more than, are they going to capture more than 29% of the digital advertising space? I don't know. Another thing is, what other things are Google's doing? Well, Google's got the Waymo autonomous vehicle business. How is that business going? How much of Google's ability to impact that self-driving car project, how much are they going to be able to beat their competition? How much is that going to be added to their own revenues? Well, in early 2018, there were analysts that projected Waymo's long-term valuation at around $100 billion. Expectations for autonomous vehicles, though, have been lowered recently for Google. Waymo in early March raised $2.25 billion in funding from outside investors. When they did that, they had to disclose a valuation in the funding. They didn't disclose that publicly. They disclosed that to the investor that made that $2.25 billion. And there are some reports that that valuation now is only $30 billion. Another thing is the Waymo CEO, the head of the autonomous vehicle unit since 2015, resigned in early April of this year. So another question is the performance of Google's hardware business. It's battling Apple's smartphones and their technology hardware-wise, and it's battling Amazon in their smart home appliances because Google's got Alexa. These are not small competitors, and that's some things we have to think about when we look for beyond expectation growth in both revenue and income. So when we think about what the takeaway is for Google, we have to think about where are they going to grow and grow faster than everybody else, and what parts of their business are they going to grow. Are they going to be able to monetize more things that they have? Are they going to be able to extract more information out of their Google Chrome, Google email to be able to find that? Or are they going to find battles with commissions and justice departments regarding antitrust, monopolizations? That's the takeaway. Where is this growth going to come from, and how is it going to outperform expectations? Well, if we think about it, what our vision of the metaverse is and how we get to use it and all that is one thing. But the other thing is, when we think about the metaverse or any other thing like that, okay, who's contributing? Who are the people that are going to contribute, or who are the companies that are going to contribute to be able to generate revenues, to generate stock returns, to be able for us to identify that they're good investments so that we can tag along with the growth in the metaverse, regardless of however it comes out and what happens with it, and whether we get to see everybody or not see everybody. So when we think about it, you're going to need networking. You're going to need a virtual platform. You're going to need hardware. Okay? You're going to need computing capability. You're going to need tools to be able to do whatever you're going to do on the metaverse. You're going to have content come in. And then you're going to have to, because this is a revenue generating world, you're going to have some payment services window. So we have to find, as good little stock market detectives, okay? We have to find companies that can be able to capture some of those in the most effective way. And a payment services might not make anywhere near as much as a content provider. So there's different people that are going to be able to generate substantial returns relative to other people. But those are the main components that I think we want to think about in terms of going to find stocks that are going to be able to benefit through this metaverse expansion and development. So if we think about it, there's like layers to this thing, okay? We start out building infrastructure. Okay, and then what we need from there is we need human interaction. So they're either on their smartphones, they're on some type of headset, whatever it is. So we've got human interaction. And then over time, we have actually a decentralization of this, because what we want is people to be able to access this independently and not just as a group. Okay, then from there, we think about, okay, this is all the 3D, and 3D is just one example of the metaverse. But that's spatial computing. So that's being able to identify and see somebody instead of on a Zoom screen, but you're actually physically seeing them in three-dimensional, so you feel like you're there. all this then creates some kind of an economy where the revenue streams and the profitability is going to be generated. And then from there, we're going to be able to develop ad revenue coming in, because what we're going to have is not only do people pay to do this, but then you're going to be able to have ad revenue come in to be able to generate more revenue and ancillary revenue. And finally, we have to think about what the experience is for the person or the groups that are that are using the metaverse, and how that generates revenue. So that's like how I think that we can think about the build out of the metaverse. So we talked about this once before, and I think that, you know, it got such treatment, or whatever you got, some enthusiastic treatment in the second half of 2021, where I wonder if people are overestimating the capacity and the capability of, or over-enthusiastic about the metaverse in the short run. But I also think that the same thing holds where they're underappreciating and underestimating and underenthusiastic about the total capabilities of the metaverse in the long run. And the reason is because we might be too optimistic today in terms of trying to develop returns based on the metaverse, but over the long run, we're going to be blown away by how fast and how impactful this could be down the road. If we just look at it today, Bloomberg did some assumptions for metaverse growth through 2024. And we can see that social media ads and stuff like that are going to be able to be involved in that thing. But most of this is all about gaming and some entertainment. And I think that's great. But I think if we're really going to expand this and it's going to be more of a lifestyle, we just don't want it to be a recreational lifestyle. We want it to be part of a lifestyle where this is how we live our life, how we do our life, not just how we have fun playing games, but how we live our life. And that's what's not yet, like, I don't know if it's been visualized by that many people, or we really don't know where it's going. As John Riccatello for Unity Software says, we don't know where this is going to be down the road. It could be billions of nodes of possibilities. But in the short run, it's going to be reliant mostly on gaming. Well, remember we talked about all the people that are going to have to be there to be able to build out this whole thing, whether we've got the software providers, or whether we've got the payment services people, or we've got the networking people, all those sort of things. But we've got so many different kinds. We've got all those kinds of people. But when we break them out and we pick companies today and we say, where could we put it in you in a box, okay? And we have all these boxes, okay? Some of these boxes of some of these like sectors of the metaverse universe, or whatever that we want to say that's going to use, that we're going to need to build out this system. Some of these people are going to be able to generate more income than others. And so if we focus on who the great contributors could be, there could be the software and the programming people. There could be the asset creation people. There could be the products that we get off of these virtual worlds. The financial services, the displays, all that, and I don't really know if it's the visual, the augmented reality and the virtual reality. I mean, once you build out those headsets or whatever they are, okay, they may become a commodity. They may not be as big as the other people, and that's what everybody's going to grab onto and they're going to look at, and they're going to say, oh, if I put on this, I can see this. But those things may be like the computer, right, or the calculator. They eventually gets to be just a piece of equipment and it's cheaper. where is the great revenue going to come from? And I think it's going to be the products, it's going to be the asset creation, and it's going to be the software and the programming. And those are the boxes where we got to find the companies in there to generate us substantial returns. I think that there are two kinds of people right now. There are the people that I talked about that are a little bit over enthusiastic. And we can even call Facebook that. But Facebook is committing serious amounts of money because it knows that there's a lead time. Google's in the same boat. And in fact, Apple is starting to hire away some Facebook employees to be able to build out their thing. And Facebook has already hired some Apple employees to be able to provide structure in areas that they are not currently experienced in. So there's a race between all these people. It's a long process, though, and I think that those companies have their eye on the prize, and they're thinking 4 years out. A lot of people that are going to make investments are quite possibly going to be I don't want to say disappointed, but will they have the long-term thought of just hanging on to the stocks and to be able to find the stocks that are actually going to make that move? And then there's the group of people that are a little more sarcastic, that are, well, let's see what happens, let's see what happens. And they're going to wait to be shown what's going on. And those are the people that necessarily aren't ever in at the beginning, and they wind up buying later. But it's tricky to be able to buy at the front end because you want to make money, you don't want to just be in and have it be a capital drain.
네, 오늘 정말 많은 종목들 리뷰를 해드렸습니다. 엔비디아, 애플, 마이크로소프트부터 테슬라, 구글, 그리고 사명을 변경한 메타까지 만나봤는데 이 많은 종목들이 모두 우리 서학개미 분들께서 정말 관심 가지고 또 눈여겨보시는 그런 종목들일 거라고 생각합니다. 이 시간 많은 도움 되셨길 바라겠고요. 올해도 버니의 미국 주식 시간에 계속해서 성장성 강한 종목들 소개해 드릴 테니까요. 저희와 함께 해주시기 바라겠습니다. 여러분 행복한 설 연휴 보내시기 바라겠습니다. 시청해주신 여러분 고맙습니다. 본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다.